Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
Retirement is being quietly stolen by video games. Bitcoin at 64 is boring. The real casino is 3 billion gamers dropping over $184 billion a year into games where they own nothing, control nothing, and donate their net worth to corporate servers that can shut off overnight. Signal 1. In 2023, players spent about $90 trillion on mobile games alone. Not consoles, not PCs, just staring at your phone while you should be working games. And those gems and skins vanish the second the company kills the server, bans your account, or decides your region isn't worth supporting anymore. That's not entertainment. That's a shadow tax on your future. Signal 2. Limited edition Fortnite and CSGO skins already trade like black market stocks. One CSGO skin sold for over $500,000. That's more than the median US home down payment. But you still don't own the asset. Valve does. Your account is a lease with vibes. You're renting fake guns in someone else's spreadsheet. Signal 3. Meanwhile, crypto gaming markets are tiny but nasty. Daily trading volume for blockchain gaming NFTs hovers in the low hundreds of millions, which is pocket change versus the $184 billion traditional gaming revenue. But here's the twist. Those blockchain items actually settle on-chain, peer-to-peer, without the publisher as middleman. Ownership is real. The casino chips finally leave the casino. Here's the cliff. Gamers are already behaving like degen traders, but the only one compounding wealth is the game studio. You, the player, are the yield. So what do these three signals scream together? 1. Gaming is already the biggest retail options market on Earth, except every option expires at 0 by design. The house wins by law. Your inventory is legally worthless. Go read a terms of service. Publishers reserve the right to delete your stuff, shut you down, change rules, no refund. That's the opposite of property rights. 2. Crypto didn't invent speculation. It just gave the speculators exit liquidity and actual title. When you buy an NFT sword on chain, it lives on a network, not inside Activision's database. Studio dies, item still exists. New game wants clout, they integrate the asset. It's ugly, early, scammy as hell in places, but the direction is clear. Digital property with a deed. 3. Gamers already understand markets better than half of Wall Street. They track patch notes like earnings reports. They arbitrage items between regions. They forecast meta shifts the way hedge funds forecast policy shifts. But no one paid them. Publishers skimmed everything. Crypto gaming flips the rake. Same behavior, new plumbing, different winner.
Does what you just heard make you want to dig deeper? Good, because that curiosity is exactly what brought you here, and the second part is going to take it further. Let's go.
Here's the mechanism nobody talks about. Gaming already trained an entire generation to tolerate extreme volatility, sunk costs, and digital scarcity. But it denied them the one thing markets use to turn degeneracy into wealth: transferable ownership. Crypto gaming injects that missing piece. You get a ledger, not just a login. If you want one concrete, non-dumb move from this, stop investing in games where your spend dies in a server and start tracking games that treat assets like on-chain property. Not because they're guaranteed moonshots, nothing is, but because at least the speculation happens on your balance sheet, not just theirs. Here's the actual playbook. 3 steps, no fluff. 1. Audit your digital spend for 1 month. Every battle pass, skin, loot box. Put the number in front of your face. You are running a negative yield hedge fund for Riot and Epic. Own that first. 2. Reallocate a fixed slice of that spend, say 25%, into an on-chain experiment budget. Not your rent money. The money you were going to burn on cosmetics anyway. Use it to learn one on-chain game or gaming-related token where assets are traded on open markets, not inside corporate databases. You're paying tuition instead of tribute. 3. Track actual liquidity, not hype. If an in-game item or token trades less than, say, $50,000 a day, you're not investing. You're stuck in an illiquid trap. Real markets have exits. If you can't get out without nuking the price, you're just early exit liquidity for the devs. You just learned one ugly truth. Traditional gaming is the most profitable, zero-equity Ponzi for corporations in human history, and you've been a volunteer donor. Crypto gaming is not salvation. It's just the first time players get a slice of the casino they already built with their time and cash. This is not financial advice. It is a reminder that your time, your risk, and your attention are capital. Treat them like capital, or someone else will convert them into theirs. So, stop donating your retirement to pixels with no deed. Start demanding receipts, ownership, and exits for every dollar you spend in a game. Summary. 1. You already act like a trader every time you chase meta and skins. 2. Traditional gaming extracts that behavior while erasing your equity on purpose. 3. On-chain gaming, done right, finally lets that behavior show up on your personal balance sheet. If you learned one real thing today, subscribe. Tomorrow we break another harmless habit that empties your future while you think you're having fun. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.